You go looking for support to grow your business, and within a few conversations, you have heard three very different words used almost as if they meant the same thing: a grant, a loan, a tax incentive. Someone tells you to apply for a grant, someone else says there is a government-backed financing scheme that would suit you better, and your accountant mentions a deduction that could quietly lower your tax bill. They all sound like help, and in a way they all are, but they are not the same kind of help, and treating them as if they were is one of the quickest ways for a Singapore business owner to waste time or make an expensive mistake. In the next few minutes, we will explain in plain English what each of these three really is, how they differ, when each one tends to fit, and a simple way to think about which might suit your situation. One important note before we start: this channel is educational only. We are not a government agency, we are not a bank or a licensed financial advisor, and we are not affiliated with or endorsed by Enterprise Singapore, Go Business, the Inland Revenue Authority of Singapore, or any government body. Nothing here is financial, tax, or legal advice, and nothing here is a recommendation to take on any particular grant, loan, or tax position. The schemes, the figures, and the rules change over time and are set by the authorities. So treat everything in this video as general background, and always confirm the current details on the official sources and with a qualified advisor before you act. Three words, three very different things. Let us begin by separating the three, because most of the confusion comes from lumping them together under the single idea of getting help with money. The cleanest way to tell them apart is to ask one question about each. Do you pay it back? A grant is money that co-funds a specific project, and in the normal course of things, you do not repay it. A loan is money you borrow and then repay over time, usually with interest on top. A tax incentive is not money handed to you at all. It is a reduction in the tax you would otherwise owe, so the benefit shows up later when your tax is calculated. Three different mechanisms, three different moments where the benefit lands, and three very different sets of strings attached. Hold on to that one question. Do you pay it back? Because it does most of the work in keeping these straight. What a grant actually is. Start with the grant because it is the one most people are chasing. A grant is co-funding for a defined qualifying project. The idea is that the business wants to do something worthwhile, such as improving productivity, building a new capability, or expanding into a new market. And a scheme agrees to shoulder part of the cost so that the project is easier to justify. The key features follow from that. A grant is tied to a specific project and specific qualifying cost, not to your general running expenses. It usually covers only a portion of the cost, so you are expected to fund the rest yourself. It typically has to be applied for and approved before you commit to the spending. And it comes with conditions, reporting, and outcomes you are expected to deliver. The great advantage of a grant is obvious. In the normal case, you are not repaying it, so it does not sit on your books as a debt. The trade-off is that grants are selective. They are tied to particular kinds of projects. The application takes effort, and the timing and eligibility rules are strict. A grant rewards a business that has a clear project in mind and is willing to work through a process to get part of it funded. What a government-backed loan actually is. Now, the loan. When people say financing in a Singapore SME context, they often mean a scheme where the government helps make borrowing easier. For example, by sharing some of the risk with a participating lender, rather than handing you the cash directly. The money itself still comes as a loan through a financial institution, and the defining feature of a loan has not changed. You borrow a sum and you repay it, generally with interest, over an agreed period. What the government backing tends to change is access. It can make a lender more willing to say yes, or improve the terms, for businesses that might otherwise struggle to borrow. The great advantage of a loan is flexibility and speed relative to a grant. It is not tied to one narrowly defined project in the way a grant is, so it can be used for broader needs such as working capital, cash flow, or funding a larger purchase you will pay off over time. You are not competing to be selected for a limited scheme in the same way. The trade-off is equally clear. It is debt. You repay it whether or not the plan works out. Interest is a real cost, and there may be conditions or security involved. A loan suits a business that needs funds now, for a purpose a grant would not cover, and that is confident it can service the repayments. What a tax incentive actually is. The third mechanism is the one business owners understand the least, because nothing is handed over. A tax incentive, which shows up in forms such as deductions, allowances, or rebates, works by reducing the amount of tax you have to pay. Instead of giving you money up front, it lets you keep more of the money you already have by lowering your taxable income or your final tax bill when the accounts are done. A simple way to picture it is this. A grant and a loan both put cash into the business now. A tax incentive changes what you owe later. Because of that, a tax incentive only helps in proportion to the tax you would otherwise be paying, which means it tends to matter most to a business that is actually profitable and paying tax. The advantages are that it can be broad, it often does not require a competitive application in the way a grant does, and it rewards activity the authorities want to encourage, such as certain kinds of investment or spending. The trade-offs are that the benefit is delayed until tax time, it depends on your tax position, and the rules around what qualifies can be detailed and easy to get wrong. This is precisely the area where a qualified tax advisor earns their keep, because the specifics matter enormously and they change. Putting them side by side, with all three on the table, the differences become easy to see. A grant is co-funding for a specific project that you generally do not repay, but it is selective and must usually be approved before you spend. A loan is borrowed money you can use more broadly, available relatively quickly, but you repay it with interest whether or not things go to plan. A tax incentive is not cash at all, but a reduction in tax owed, broad and often automatic in nature, yet delayed and only useful if you are paying tax in the first place. Notice that they answered different questions. A grant asks, is there a specific project worth part funding? A loan asks, do you need money now that you are able to repay? A tax incentive asks, are you already spending or investing in a way the tax rules reward? Seen like that, they stop competing in your mind and start occupying different roles. And a growing business will often meet all three at different moments. The strengths and the trade-offs, it helps to be honest about what each one costs you because none of them is free in every sense. A grant costs you effort and time. The money may not be repaid, but you pay in preparation, in meeting conditions, and in accepting that you might not be selected. A loan costs you interest and risk. It is fast and flexible, but it is a genuine liability that has to be serviced no matter how the year turns out. A tax incentive costs little in effort by comparison, but it only rewards you if you are profitable and if your spending genuinely qualifies. There is no universally best option here. The right one depends on your situation, whether it is a defined project or a general need, whether you can carry debt, and whether you are in a tax-paying position. Anyone who tells you one of these is always the smart choice is not paying attention to your circumstances. A simple way to think about which one fits. So how do you actually reason about it? Start from the need, not the label, exactly as you would when choosing any form of support. If you have a specific defined project and you can wait for approval before committing, a grant is worth investigating first, because money you do not repay is the cheapest money there is when you can get it. If you need funds now for a broader purpose that a grant would not cover, and you are confident you can repay, a financing option is the natural place to look. And whether or not either of those applies, if your business is profitable and already investing or spending in certain ways, it is worth asking a qualified advisor whether a tax incentive quietly reduces what you owe. These are not mutually exclusive. A business might fund a project partly with a grant, cover its wider cash needs with financing, and separately benefit from a tax incentive on qualifying spend, all in the same year. The point of understanding the three is not to pick a favorite, but to recognize which tool matches which need. Verify before you rely on any of this. Here's the reminder this channel keeps coming back to, and it matters even more once tax and borrowing are involved. Everything we have described is the general shape of these three mechanisms, not the current detail of any specific scheme. The exact grants on offer, their co-funding levels and conditions, the financing schemes available and their terms, and the tax treatments and what qualifies for them are all set by the authorities and change over time. So treat this video as background only. When it is time to act, confirm the live details on the official sources, and for anything involving borrowing or your tax position, speak to a qualified professional who can look at your actual numbers. A grant question can start at gobusiness.gov.sg and enterprisesg.gov.sg. A tax question belongs with the Inland Revenue Authority of Singapore and a qualified tax advisor. Getting the general concept straight, as we have here, simply means you walk into those conversations already knowing which door you are looking for. A closing reminder. Remember the spirit of this channel. Our job is to hand you the map and the vocabulary, so the process stops feeling like a mystery, and you can tell these three forms of support apart the moment they come up. A grant co-funds a project and is generally not repaid. A loan is borrowed money you repay with interest, useful when you need funds now. A tax incentive reduces the tax you owe rather than handing you cash and rewards you when you are already profitable. None of them is better in the abstract. They simply answer different questions, and knowing which is which puts you back in control of the conversation. Nothing here is a promise about any particular scheme, and no one can honestly tell you which is right for your business without knowing your situation. So verify the current rules officially and get advice on your own numbers before you act. If this made the difference clearer, subscribe for a new Singapore funding breakdown, and we will keep turning these schemes into plain English, one topic at a time, so you can stop guessing and start choosing with your eyes open.